He was losing millions while everyone else was celebrating. Investors were furious, some demanded their money back, and on Wall Street he was quietly labeled reckless. In 2006, when the housing market looked unstoppable, almost no one believed anything was wrong. My name is Edmund Hale. I study the moments before collapse, not when panic begins, but when confidence feels untouchable. In 2006, confidence was everywhere. Homes were selling before the paint dried, banks approved loans without hesitation, and every rising price reinforced the same belief: the system was safe. Traders celebrated record quarters, and bonuses were calculated months in advance. Leverage expanded quietly in the background, yet no one asked who would carry the risk if something failed, because failure did not feel possible. Mortgage bonds were stamped AAA and treated like cash. Safe, reliable, predictable, that word echoed across trading floors and boardrooms until it stopped being an assessment and became a conviction. If someone questioned housing, they were dismissed. Real estate always goes up, they said, and what began as optimism slowly hardened into doctrine. Funds increased exposure, banks packaged more debt, and investors demanded higher returns. The higher prices climbed, the stronger the belief became, and the stronger the belief became, the less anyone felt the need to question it. The structure did not look fragile. It looked modern, engineered, advanced. And when something feels advanced, people assume it must also be safer than what came before. No one prepared for collapse. No one hedged aggressively. No one imagined that the foundation beneath the growth might already be thin. They were making money, they were respected, and they were rewarded for confidence. They were certain, and certainty, when left unexamined, is always quiet before it breaks. While the market celebrated expansion, Michael Burry was sitting alone in his office reading loan documents. Not summaries prepared by sales teams, not marketing material designed to reassure investors, but the actual contracts behind the mortgage bonds. Thousands of pages describing the borrowers who stood beneath the structure everyone trusted. He studied adjustable rate mortgages with teaser rates that would reset in 2 years. He examined loans issued without verified income, debt granted on the assumption that housing prices would continue rising without interruption. On the surface, everything appeared manageable. Default rates were still low, housing prices were still climbing, and banks were reporting strong profits. But inside the details, the structure felt different. The weakest loans were being bundled together and sold as safe investments, wrapped in complexity and stamped with high credit ratings. Risk was not disappearing. It was being redistributed and disguised in layers that made it appear distant from its origin. The bonds were rated AAA, yet many of the borrowers beneath them were already stretched thin. Income assumptions were optimistic, debt levels were aggressive, and repayment depended less on stability and more on the continuation of rising prices. The entire system rested on a single condition: housing prices could not fall. They did not need to crash. They did not even need to reverse sharply. They simply could not stop rising, because the moment growth stalled, the weakest loans would begin to fail. And once those loans failed, the bonds built upon them would start to fracture. Burry was not searching for headlines. He was searching for patterns. He noticed that the structure relied on momentum rather than resilience, and that what appeared diversified was in fact deeply connected. If one segment weakened, the damage would not remain isolated. It would travel. While others saw innovation, he saw leverage. While others saw distribution of risk, he saw concentration of vulnerability. The complexity that reassured the crowd only made the fragility more visible to him. The numbers did not shout warnings. They repeated the same imbalance over and over again, and repetition, when consistent, carries more weight than a single dramatic signal. The market still looked strong. Confidence remained visible. Nothing in public behavior suggested instability. But beneath the surface, the foundation was thinner than anyone realized. And almost no one was looking there. At first, no one noticed what he was doing. The positions he built against the housing market were quiet, technical, and easy to ignore. because prices were still rising and the broader narrative had not changed. Then the losses began to accumulate. The housing market had not collapsed, the bonds had not failed, and nothing dramatic had happened in public view. But the insurance he was buying required premiums, and those premiums were draining his fund month after month while other managers continued posting gains. Investors started calling. At first they wanted reassurance, then they wanted explanations. Eventually they wanted exits. They watched competitors celebrate strong returns while their capital was tied to a position that appeared increasingly wrong. And in markets, appearance carries more weight than structure. Some accused him of misjudging the system. Others questioned his discipline. A few threatened legal action if performance did not improve. He tried to explain the resets embedded in the loans, the fragility hidden beneath the ratings, the dependency on rising prices that no one wanted to question. But until something visibly breaks, the crowd trusts what it sees, and what they saw was a market that still functioned. He was early, and in markets, early often looks identical to wrong. Pressure intensified as redemptions loomed and reputations were tested. The easiest decision would have been to reduce exposure, calm investors, and return to alignment with consensus, because alignment feels safe even when it is structurally dangerous. But he returned to the data instead. The patterns he had identified were not disappearing. Delinquencies were creeping upward in the weakest segments. The resets had not even fully begun. The structure was tightening, even if prices had not yet reflected it. He understood something most participants resist. Markets rarely reverse during chaos. They reverse during agreement. When continuation becomes the default expectation and risk is assumed to be managed, fragility has already begun spreading quietly beneath the surface. Isolation is the price of independent observation. The more confident the crowd becomes, the more alone the dissenter stands. And the longer the system appears stable, the harder it becomes to trust a conclusion that contradicts visible reality. He did not close the trade. He waited. Not because he was certain of timing, but because the structure had not changed. The dependency was still there. The leverage was still there. The imbalance was still repeating. Losses continued for a time and the pressure did not ease. But conviction in markets is not built from emotion. It is built from consistency in what the data reveals. While others measured success by quarterly returns, he measured risk by structural weakness. And the weakness was spreading. By early 2007, the shift began to appear, but not in headlines and not in dramatic price moves. It appeared in behavior. Delinquencies in subprime mortgages were no longer isolated anomalies. They were increasing in clusters, and the pattern that had once looked contained was beginning to widen. Borrowers were missing payments before their teaser rates had even fully reset, which meant the system was weakening faster than the models had assumed. The first cracks were subtle, but they were measurable. Burry saw acceleration where others saw noise. The data he had been tracking for months was no longer theoretical. It was moving from spreadsheets into market structure. Yet the broader market remained calm. Prices had not collapsed. Analysts were still confident. Institutions treated early weakness as a temporary imbalance rather than a structural flaw. In public, the language of stability remained intact because stability is easier to defend than fragility. But liquidity began to thin. Bonds that once traded effortlessly required negotiation. Pricing became less precise. What had previously been automatic now required explanation. Confidence did not disappear, but it began to require reinforcement. Inside his fund, the tension did not fade. Investors wanted visible proof, not slow confirmation. The market had not yet broken, and without visible breakdown, doubt always targets the dissenter first. He did not announce victory. He increased exposure, not recklessly but deliberately, because the underlying dependency had not changed. Housing prices still needed to rise to sustain the structure, and the moment they stalled, the weakest links would begin to fail in sequence. What had once been gradual deterioration was becoming momentum. Lenders began reporting higher default rates. Smaller mortgage companies started collapsing under pressure. Credit conditions tightened quietly, not as panic, but as caution. Conversations shifted from expansion to exposure. The system was still functioning, but it was no longer expanding with the same confidence. The difference was subtle, and subtle differences are often dismissed until they become unavoidable. Most participants waited for visible confirmation before adjusting their positions, because visible confirmation feels safe, even if it arrives too late to be useful. Burry understood that confirmation does not create opportunity, it closes it. By the time fragility becomes obvious, the price is already adjusted. By the time the crowd acknowledges risk, the structural imbalance has already been exposed. He did not need panic to validate his view. He needed consistency in the pattern, and the pattern was no longer stable. By mid-2007, what had been dismissed as temporary weakness could no longer be contained. Mortgage lenders began failing, not in dramatic waves at first, but in enough numbers to change the tone of the conversation. Funds exposed to subprime debt started reporting losses, and liquidity, once taken for granted, became selective. The system did not collapse overnight. It tightened. Banks that had confidently created and distributed mortgage products began marking down assets they once defended publicly. Pricing became uncertain, counterparties grew cautious, and conversations that had once focused on growth slowly shifted toward exposure. Still, many believed the damage would remain isolated. They argued that subprime was a small segment, that diversification would absorb the shock, that the broader market remained stable. The language of reassurance persisted because reassurance protects belief longer than evidence protects reality. Then the first undeniable signals appeared. Hedge funds tied to mortgage securities imploded. Losses that had been theoretical became visible, and what had once been dismissed as noise began to resemble structure. Institutions that had insisted on stability were suddenly forced to acknowledge fragility. The unwinding did not feel sudden to those who had studied it. It felt consistent. Positions were liquidated, credit conditions tightened further, trust between institutions narrowed. What had once flowed easily through the system began to stall, and when liquidity stalls, leverage reveals itself. The housing market, once described as unstoppable, began falling in earnest. Defaults spread beyond the weakest borrowers. What had been contained at the margin started moving toward the center. The collapse was not dramatic in design. It was inevitable in structure. Inside his fund, the positions that had drained capital for months began paying out. Credit default swaps surged in value, and the same trade that had isolated him now appeared disciplined. Investors who had questioned his judgment were suddenly witnessing extraordinary returns. But profit was not the defining moment. Recognition was. The market did not collapse because of a single headline or a single event. It collapsed because the belief that sustained it had already outrun the structure beneath it. By the time panic became visible, the imbalance had already done its work, and Burry was no longer reacting. He had already understood what the system required in order to survive, and he had already seen that requirement fail. My name is Edmund Hale. I do not record the collapse. I record the moment before it becomes visible. What happened in 2008 is remembered as chaos, panic, and sudden failure. But collapse is rarely sudden. It is the final expression of decisions made long before fear appears on the surface. The critical moment is quieter. It exists when confidence remains intact, when institutions continue expanding exposure, and when investors demand performance without questioning the structure that produces it. It exists when success feels stable enough to remove doubt, and when repetition begins to replace scrutiny. The most dangerous phase is not when the system breaks. It is when it still appears unbreakable. Michael Burry did not succeed because he predicted disaster. He succeeded because he studied behavior while others studied price, because he examined structure while others trusted momentum, and because he measured fragility while the crowd celebrated continuation. That difference is subtle, but it is decisive. The crowd reacts to what becomes visible. The observer studies what is forming before visibility demands attention. Markets do not collapse because participants lack intelligence. They collapse because participants trust repetition more than observation. When something works long enough, it begins to feel permanent. When it feels permanent, preparation fades. And when preparation fades, fragility is allowed to grow without resistance. By the time headlines confirm what is happening, the opportunity to recognize it has already passed. What feels sudden is often the result of patterns that were visible long before they were acknowledged. The moment before the fall does not announce itself. It offers consistency to those willing to look without expectation. Confidence expands, doubt disappears. Success becomes assumption, and assumption gradually replaces awareness. Nothing appears wrong until the structure can no longer support the belief built upon it. The fall is never the beginning. It is the confirmation of what had already shifted beneath the surface. And confirmation, while comforting, always arrives too late for those who required it in order to act. This is why these stories matter. Not to glorify prediction, and not to celebrate profit, but to examine the quiet separation between belief and reality. That separation is where every collapse begins, and it is where clarity must be found before visibility makes it obvious. This is Before the Fall Chronicle.